record this for everybody too. We'll send this out. So short-term rentals are deemed by the IRS as a non-passive investment. They're deemed as active. And so because of that, we can actually take advantage of something called accelerated depreciation. So from a high level, let's say that you were to buy a property and you were to use it as a short-term rental as opposed to a long-term rental. Because the IRS deems this as a non-passive activity, you can actually take 20 to 30% of that value of the property as a year one loss by doing something called bonus depreciation, which is accomplished through material participation. Now, if it just sounds like I started speaking in a different language, that's okay. We're going to get into all of these terms. So one of the things that I mentioned was bonus depreciation. So bonus depreciation is basically allowing you to take advantage of something called depreciation. Now, what is depreciation? So let's take a home, for instance. So we're taking depreciation on a home. Depreciation is basically a fancy way of saying that when you buy a physical asset, all of the components of that physical asset are eventually going to need to be replaced. So even though a home appreciates in value every single year, there are going to be things that eventually you're going to have to replace. Even if you have a brand new kitchen, over the span of 39 years, that kitchen is likely going to lose its value. So because of that, the IRS allows you to take a little bit of that value every single year over 39 years. So if you had a traditional long-term rental, for instance, you would be able to take a small amount of depreciation every year over 27 and a half years. So to make this simple, let's say that you bought a $270,000 property. If you were to take just normal depreciation on that property over 27 years, that would be $10,000 a year that you could take as a loss against your ordinary income. So that's great, but let's say that you're, a high income earner. Let's say that you're someone who's making $200,000 a year. If you're just taking a line item loss of $10,000 a year, you're still going to be taxed on $190,000, which would be really significant. So the coolest thing about short-term rental is instead of you taking a little bit every single year, because it's deemed by the IRS as an active activity, you can actually take all of the bonus depreciation in year one. Now, before we really get into this, I do want to talk a little bit about, who I am and just my experience in this. So, as I said, I'm one of the co-founders of Good Neighbor Realty. I have my own portfolio of short-term rental investments throughout the state of Colorado. It's been so powerful for me personally and my family because we've not only been able to grow a cash flowing investment portfolio, meaning we're making money every single year from our investments over what we owe on our mortgage and expenses, but I'm able to offset my earned income as a broker. The other thing to take into consideration during this entire presentation is I'm not a CPA, I'm not a financial advisor. And so everything that is said today, please make sure to talk with your CPA. And we're going to talk about how to identify a really good one too. Okay. So let's talk about traditional depreciation versus accelerated. So let's say, and we're going to talk about like some higher value property numbers just because the numbers are a bit easy. So let's say that you were to buy $1 million traditional investment property. You can't depreciate land. You can only depreciate the things inside the property that are going to lose value. And the way that they do this is they actually do something called a cost segregation study. And they'll go out to the property and they'll say, okay, this cabinet has a lifespan of 5 years or 7 years. And so someone will actually go out and evaluate how many things in that property actually are eligible for what we're talking about, which is bonus depreciation. So in a non short-term rental scenario, if you were to take a property that's worth $1 million, you were to take away the land because that's not depreciable, your depreciable basis is 800,000. So your annual depreciation amount for this property would be, if it would be about $20,000 on this $1 million property. So $20,000 again as a loss against your ordinary income, that's great, but it's not necessarily going to move the needle like a short-term rental would. So if you take an annual depreciation of approximately $20,000 on a $1 million long-term rental property for someone in the 32nd percentile tax bracket, this would be an estimated of $6,500 in tax savings. So that's great, but again, like not as much as what you could. And if you're someone like me, I remember just seeing all these people talking about how they're investing in real estate and they're paying so little in taxes, or how, the wealthy continue to get wealthy because they're amazing at keeping their money, as well as earning money. I was always so frustrated because I couldn't figure out how they were doing this. So a very common way is bonus depreciation. So let's say that you, instead of buying a long-term rental, buy a short-term rental for $1 million. The land value is the same, it's $800,000. You would then do something called a cost segregation study. Now, this cost segregation study is going to evaluate how much depreciation you can take in this property. And in a short-term rental type of property, it's actually going to be over 39 years as opposed to 27 years. And so the cost segregation study, typically we see about 20 to 30% of the property value that you can take in depreciation. So let's say that the cost segregation study identifies about 300,000 in assets that are eligible for faster depreciation. In 2025, we are allowed to take 40% of that. It used to be 100%, and actually something that the new administration is talking about is bringing back 100% depreciation. It was passed last year, but it's been on hold. We'll see. A lot of advisors are saying that, we're going to kind of find this out in the next couple of months. It could go back up to 100%, or it might kind of fall in between where we're at now, 40 and 100%. But it is something that the new administration is pushing for. So right now we can take 40% of that 300,000 against our earned income and against the short-term rental income as loss. So let's say that you take 40% of 300,000. That's $121,000 that you can take as a loss against your earned income. So if you were to take first year deduction of $120,000 on $1 million property for someone who's in the 32nd percentile tax bracket, that would be $38,000 in tax savings. And that is far more than what the example that we just had right before of $6,000. So, accelerated depreciation, we've been talking about this term. By using a cost segregation study and 40% of the bonus depreciation, a short-term rental owner can save approximately $38,400 in taxes in the first year versus $6,500 if it were just a long-term rental. So let's really get into this. Let's talk about an example of someone who, maybe is a high income earner. And I do want to stop right here and say, a lot of the examples that we're using are big numbers. They're $1 million property purchases. They're someone who earns 250,000. From a brokerage standpoint, we have investors who will invest in properties anywhere from 400,000 here in Colorado all the way up to $7 million to offset their taxable income. And so if these numbers feel big and you're like, I don't make nearly that much, that's okay. Or if you make far more and you're like, I don't really care about the cash flow, I'm just really looking for a tax strategy. This is for you. So don't take these examples as the only way to do this. There's a wide range of how you can invest in real estate in a way that's going to make sense for you, your family, in your particular situation. But let's look at someone who earns 250,000 in tech sales. So let's say first that we need to determine how much does this person actually pay in taxes. Now, I'm just going to focus on the federal income taxes that this person pays, but in reality, a person who's making 250,000 in tech sales, after you pay Social Security and income tax, they're actually going to be taxed at close to $80,000. For just the federal income tax alone, if he were to make 250,000, you get a $15,000 standard deduction, and then you're taxed based off of marginal tax bracket. And so someone who's making 250,000 just in federal income tax without significant deductions would be taxed about $57,000. But that doesn't include, again, state income tax. So let's say that in this example, Bob works in tech sales and he is taxed about $57,000 annually. Let's say that he wants to come up with a strategy where he gets his tax liability down to zero. Maybe Bob heard about the STR loophole through attending this webinar or through another friend or family member, and he decides that he wants to purchase a property. So he decides to purchase a property in Colorado. He decides to purchase this A-frame. This is actually one of my properties, and we're going to get into this particular property as an example. This property is an hour west of Denver. It's an A-frame. It's a 4.3. It's an active short-term rental. It was something that my husband and I purchased in 2022 for about $900,000. My husband's a contractor, so we put some work into it. And this property absolutely kills it. It makes about $195,000 in gross revenue. I'll show you guys what that looks like from a cash flow perspective as well. So let's say that he bought this property. Property value is $915,000. The land value is about $137,000. So the depreciable basis on this property is $777,000. So what we would want to do first is a cost segregation study. I'm actually going to show you all the cost segregation study that we had done on this property. So we used a company called RCG Valuation. I'm happy to make introductions to this company if anybody has any particular questions on it. Someone said, I thought it was 39 years for commercial properties and 27.5 for residential. Are short-term rentals considered residential properties? Good question. Short-term rentals are similar to commercial properties in the sense that the IRS does it over 39 years, not 27 and a half. So here's RCG. You can see how they did the study. It's really interesting when you get into this report. You can see how they broke down all of the interior components. It's a really long report. The study itself costs anywhere from $2,000 to $5,000, and you can see like they do everything from like the garbage disposal, and they'll do like carpet and carpet pads, and so they go through the interior components of the property, and they give a lifespan. And they tell you exactly how much you can deduct based off of the interior components of the property. So the adjustment here was $277,000 that I was able to take as depreciation to apply towards my earned income. So after identifying that $277,000, in 2025, you could take in 2025, you could take 40% of that. So your first year depreciation is going to be $111,000. So the way that we came up with this figure is we did a cost segregation study. They identified the components in the property that were eligible for depreciation. And in 2025, we can take 40% of this value, that $277,000. And so it gives me a write-off of $111,000. So Bob in year one could deduct $111,000 from this A-frame, which he's operating as a short-term rental property. And that translates to a $35,000 tax savings. Now let's kind of talk through this. So that's like a great amount of tax savings, but Bob, obviously he earns $250,000. He has more than a $35,000 tax liability. In fact, he has a $57,000 tax liability just in his federal income tax. So let's talk through all of the different tax savings that you can actually have. So here's something that we use a lot. This is a pro forma where we underwrite what a property's potential is. So we look at a couple of things when we're underwriting a property. We look at the income potential of a property, but we also look at the many other financial benefits. And so what I did was I actually did this based off of my property and the real numbers for this property. So this property is located, again, an hour west of Denver. Purchase price was $915,000. We put 20% down. Today's interest rates are roughly 6.5%. And also, I just want to stop by saying if you guys need fantastic lenders who are very used to working with people who buy real estate, who are investor minded, I have fantastic recommendations for lenders. At the end of this presentation, you can email me. You can also drop in the chat lender with your email, and I'm happy to make an introduction to that. These taxes and insurance are based off of our real taxes and insurance. Some other things to think about when investing in a short-term rental is there is substantial startup costs when it comes with furniture or when it comes to furniture and design. Is it possible for you to find something that's already furnished and designed? Yes, but that is extremely rare. So we have all of the furniture and the design, and we also had some renovations on this as a part of this calculation. We have all of the expenses that I have at this property, from electric, gas, cable. We have capital expenditures, which is just a fancy way of saying reserves for when stuff breaks. We have snow removal, pest control, hot tub maintenance. And then here you can see like our average nightly rate. So another important thing, like a short-term rental is defined as a property that is rented on average for less than 7 days at a time. So our average nightly rate at this property is right around 575. Occupancy is right around 83%. On a low end, we charge $400 a night for this. On a high end, around $750. So we make a grand total with our cleaning fee of about $194,000, which equates to a lot of cash flow. Now, this property is definitely like an outlier. We clear about $7,000 after paying for all of our expenses. Our clients typically, depending on what type of asset they're purchasing, will clear anywhere from $1,000 a month all the way up to what we're doing, $7,000, $8,000, $9,000 a month, just depending on down payment and the type of asset. Something I'll say too about this particular property is while it's an amazing cash flow property, it's not in a highly appreciating market. So it really depends on your style, but we work with people who have all different sorts of goals. But here's what I really want to get into is the estimated tax savings. So we've already talked a little bit about bonus depreciation. We have this calculation where we have the estimated land value, the estimated amount of bonus depreciation, and then the estimated tax savings based off of your income bracket. But then there's also so many other things that you can take advantage of. So general tax savings also includes all sorts of things like your operating costs. It includes the interest that you pay on your loan every single year. It includes your cleaning fees. It also includes all of the investment that you've made into not even just this number, but this number, this total tax write-off of $250,000 includes any investment that you may have made into furniture or renovation or design. Now, let's say, okay, Chantel, we get it. Like if you spend a lot of money, you get to write off your taxes. That's not, it doesn't have to be that way. Like even if you just focus on, straight line depreciation. So there will be things that you can do bonus depreciation on. That's all of the interior components. That's things like your cabinets, your hardware, your flooring. But then there's also things that you get to take straight line depreciation on. So anything that is given a lifespan more than 5, 7, or 15 years, you would take straight line depreciation on, and you get to continue to take that every year. But the accelerated depreciation is based off of the components that the cost segregation study has deemed that have a shorter lifespan. So between straight line depreciation, between your operating expenses, your mortgage interest, your property tax, all of these are other things that you could squeeze another $80,000 in write-offs just from owning this property. And that's before you even consider the losses that you would experience year one from furnishing and designing it. And then some other things to consider in this is not only are you getting tax savings, but you're getting significant cash flow. Typically in short-term rental is able to make 2 to 3 times more what you would cash flow in a long-term rental. And then you're getting things like principal pay down and appreciation. So, the coolest thing about real estate is like, even if you did nothing else, but you had tenants occupying your real estate, they're paying your monthly principal every single year or every single month. And so if you just held that property for 30 years and had someone else pay your mortgage, at the end of that 30 years, now you own an asset that has appreciated in value. So between cash flow, tax savings, and appreciation, mortgage pay down, there's just a lot of financial benefits. And you can kind of see, like, over time, over 5 to 10 years, it just gets better and better. Okay, so let's go back to Bob. So remember, Bob owed $57,000 in federal income taxes. Now that he has a short-term rental, he can take advantage of that $35,000 in bonus depreciation. But then I just showed you another $80,000 that he has in write-offs due to his straight-line depreciation, operational expenses, his cleaning expenses, and his mortgage interest. And so if he's in that 32nd percentile tax bracket, then he has another $25,000 in tax savings, which equals $61,000 that he can save in taxes without even including the furniture and rehab that he may or may not have put into this property. So, how much does Bob owe in his taxes? He owes $0, and those additional losses over the $57,000 can actually be used in 2026. Now, let's talk through how to qualify. So, this is like, this sounds great, but like there has to be like some things that make this difficult for the ordinary person to do. And there certainly is. So, one of the biggest things is you have to materially participate in this activity. So, this really is difficult for people who want to get into this space and use a property manager. It really is important that you are participating in your property, and we'll define exactly what that is in the following slides. The other thing is you really need to work with a cost segregation study and a CPA who knows how to take advantage of this. So again, like, you want to work with someone who is a cost segregation specialist who can send someone out to really get a good idea of all of the deductions that you can take on your single property. Again, this study is typically anywhere from $2,000 to $5,000, depending on the property. We've seen as much as 10 to 15,000. So let's talk about how to materially participate. So, because again, the IRS says we're going to allow you to take a greater tax deduction for material participation, what are they looking for? So, there are 7 different things that most investors look to qualify for material participation, but these are the 3 that our clients use the most. So, the first one is spending over 500 hours annually on the activity. The second one is performing most of the work of the activity yourself. So that kind of disqualifies you from hiring a property manager. And then the third one is participating over 100 hours if no one else spends more time. So this really comes down to, if you are spending a little around 2 hours a day, like managing your short-term rental, that's a way to qualify. But a lot of times we're able to have people self-manage and not spend that 500 hours, but they're doing the majority of the work themselves. They don't have a property manager spending any more time. They can prove that they are the person spending the most time managing this property. For my properties, I spend a couple of hours every single week. I have a portfolio of 6 properties. 4 of which are active short-term rentals. I have a great tech stack where I've completely dialed it in. A lot of times people are like, I can't imagine having to manage like an active short-term rental, but really it's not bad. So I have a cleaning team that takes care of all the cleaning. I have automated guest messaging, and so I'm not having to, message guests all the time. I have automated locks and security systems. And so really with the automation, the work that I have to do for the short-term rental is really not that intrusive. Another way is participating over 100 hours if no one else spends more time than you. So we've had clients in the past like really not want to manage a short-term rental property themselves. And so what they'll do is they'll purchase the property towards like the end of the year. and then they'll spend 100 hours on the property, and that could be, helping with furnish the property, helping design the property, managing it for a couple of months, and then the next year taking advantage of that bonus depreciation in the year that they're spending 100 hours, and then the next year flipping it over to management. So if you do decide, that you don't want to be a long-term manager, you could do it for the tax year that you're taking advantage of this material participation. Now, here's a question that a lot of people ask. What happens if you sell? So when you sell a property that you've taken bonus depreciation on, you may have to pay something called recapture. So some of the deductions that you've taken are considered ordinary income. And so if you buy a property, do the cost segregation study, save all this money on taxes, and then you go and sell, this recapture means that you might have to pay some or all of that back at a higher rate than when comparing to long-term capital gains. But there is a way to avoid this. So the coolest thing about real estate is, that there's so many different ways to defer taxes. The best way to do this is through a 1031 exchange. So let's say you buy this investment property, you take advantage of, the tax benefits for short-term rental investors, then you sell the property and you don't want to have to pay back those taxes that you saved, you could actually do a 1031 exchange property. The key here is that to fully defer these taxes, that the replacement property needs to be of equal or greater value and contain an equal or greater value of the depreciable property. So if your replacement property has less depreciable property, meaning if you do the cost segregation study, and you can't take as much, then you will be liable for some of those taxes. But in most cases, if you're buying a more expensive property through the exchange, it's not an issue. And again, you really want to navigate this with a CPA who's experienced with this. Okay, let's talk through a couple of questions. So Samantha says, would love to hear how the tax offset would work from an investment standpoint if you were to purchase land and then build the house, like purchasing a turnkey short-term rental. That's a great question. So at that point, like you would just do this cost segregation study after the property is fully built. And in the same way, you would just exclude the land. And so it really comes down to a timing thing for that one. Someone else said, how does the tax loophole work for people with W-2 incomes? So this really comes down to self-managing. So there is another way for you all to take advantage of this strategy by becoming a real estate professional. That's often not possible when people have W-2 and W-2 jobs, because in order to be a real estate professional, you have to prove that that's what you spend the majority of your time working on. And so if you have two W-2 incomes, really the way to do it would be to prove material participation through self-managing for your short-term rental. Does it matter when in the year you buy the property and get the STR operational in order to maximize the tax benefits? Another great question. So does it matter when you buy the property? It really matters when you put the property into service. So for someone who is worried that, we might not continue to get bonus depreciation long term, if you don't think that maybe this administration is likely to bring it back and you see that this is phasing out, it would be really important for you to focus on buying and launching the property in 2025. So the year that you put the property up as a short-term rental, that is when you can take the tax benefit. Now, let's say that you've owned a short-term rental. I was in the situation for a couple of years and you had no idea that this was even a thing. You can actually amend your taxes and go back and retroactively apply the bonus depreciation that you missed out on based off of the year that you put it into service. Someone asked if this only works year one. So in year one, that's when you're taking the majority of this tax benefit. Yes. So that like the best thing is that like you're getting to apply this to the year that you put it into operation. You do have other tax benefits like the straight line depreciation, like the operational costs, like the mortgage interest that you can take every single year, but the majority is in that year one. And so the people who are using this strategy are saying, okay, I'm buying a short-term rental once a year, every year to offset my income, or once every couple of years. All right. So for any of you who like jumped on here and you're looking for more resources on this is something that we really get into like further in depth. We have a short-term rental course. There is tons of videos in that short-term rental course that you can go through. And we'll send you information on the course. It's only $500 for anybody who's attended this webinar. And it has lots of things. We have lots of events, as you've seen. We have webinars as well as in-person events. The underwriting that we went through, that's something that we do for every one of our clients that's underwriting a property. And then we also have a podcast called B&B Financially Free. I have two different interviews on that podcast, one with a CPA and one with a cost segregation specialist. We'll link that in the follow-up email too if you want to hear more about this. And then we will also send out this presentation after, and we can send out the recording of this as well. If this was a lot and you were like, I would love to know how this pertains to me, we are happy to schedule a one-on-one call with you. This is my Calendly link. If you go and sign up here, you can take a picture on your screen, or we'll also send this out with a follow-up email. You can chat with one of us and we can look at your particular situation. We can talk about, whether or not you're a W-2 earner, or whether or not you can qualify as a real estate professional. We can chat with you about like, the best places to invest in short-term rental. We obviously love Colorado, but if you're looking at other markets, we have really, really good connections in those other markets too. If you have a particular question for me, or you want to be connected with someone in our network, whether that is a cost segregation specialist, a CPA, a lender, a realtor, a designer, a contractor, we have some of the best vendors and we just love building this community. And so you can send me an email. It's Chantel at The Good Neighbors, and we will connect you. With them. Let's see, there's a couple more questions. If I'm going to launch my short-term rental next month, should I do a depreciation study before the tax date, or do I do it next year? So I would definitely like chat with your CPA, but I would definitely suggest doing a cost segregation study this year. And if you're launching it in 2025, you could use it for your 2025 tax year. If you waited to do your cost segregation study, it's not going to hurt anything. You can do it in 2026 as well. But it's always nice to do it like quicker, in my opinion, just so you can start strategizing with your CPA. Someone else asked, what is the current percentage of bonus depreciation? Isn't Trump possibly going to set it to 100% again? So currently it is at 40%, and there definitely is talks of the new administration setting it back to 100%. We're hopeful for that. We think that there's a lot of signs that it could, but we're just not sure yet. Here's our course. So if you want to like learn more about short-term rental, we talk all about cost segregation, bonus depreciation, 1031 exchange, finding, launching, identifying a short-term rental, how to make it super lucrative, all the brokers within our firm. So just so you all know, like when you work with a broker in our firm to find a short-term rental property, these are things that we're educating you on the entire transaction. So not only are we being the realtor, helping you identify the property, negotiate a great deal, but we're also educating you on everything that we know about short-term rental investing. And every one of the realtors within our firm is highly educated on short-term rental investing. all of them own short-term rentals. We navigate the legislation, all that good stuff. So if this is something that would help you, we can certainly do that. And we don't charge anything extra for using our brokers that are short-term rental specialized. They just get paid just like a normal realtor, through negotiating their commission directly with the seller or through a normal realtor commission. We just have a ton of resources for investors because this is why our firm exists. Here is the podcast that you all can subscribe to, B&B Financially Free. Again, there's like a really great interview on there with Troy Vigil, who's a CPA and then also a cost segregation specialist. So there's another 2 hours that you can just listen into. And then this is our social media that we'd love to connect you in. So if there is no other questions, I will let you all get on with your Wednesday. I thank you so much for joining us. I hope that this was helpful. I'd love to hear from you. Send me an email and we will look forward to hearing from you all soon. And have a wonderful day. Bye, everybody. I will leave this up for a little bit just so people can get our information. I'm actually going to go back to this Calendly link with my email. So if you would like to book here, you can do so.